Hey everyone, we're diving into a topic today that might feel a little overwhelming, especially if you're, early in your career. We're talking about investing for young people.
Investing young is the best time to do it.
It is, but I know thinking about retirement when you're just getting started can feel a little bit like planning a trip to Mars.
Yeah!
But trust me, you'll want to stick around because we're going to unpack why starting early is like a financial superpower. And we'll also talk about how to make it happen without you needing to become a financial expert overnight.
I think a lot of young people don't realize what an amazing advantage they have when it comes to investing. They have time.
They have time, that's true.
And that is the secret weapon in wealth building.
Okay, so let's break this down. Why is time such a big deal when we talk about investing? I mean, is it just because the sooner you start, the sooner you retire and, sip margaritas on a beach somewhere?
Well, early retirement is definitely a perk, but it goes deeper than that. Have you ever heard of the magical power of compounding?
Compounding. That sounds a bit like a chemistry experiment gone wrong.
Not quite. It's actually one of the most powerful concepts in finance. Imagine a snowball rolling down a hill.
Okay.
It starts small, but as it rolls, it gathers more and more snow, growing bigger and bigger.
Yeah.
That's kind of what happens with your money when you invest it early. The returns you earn start generating their own returns. And over time, this creates the snowball effect that can lead to, significant wealth.
So it's not just about putting money in the market and hoping for the best.
No.
It's about letting that money work for you.
Right.
Generating more money, which generates even more money.
Yeah.
It's kind of like a financial chain reaction.
Exactly. And the earlier you start this chain reaction, the more powerful it becomes. Even small, consistent contributions that you make in your 20s or 30s can add up to a substantial nest egg by the time you retire.
So starting young means I don't have to stress about saving a ton of money right now. Phew, that takes some of the pressure off.
Oh.
Okay. But let's say I'm convinced about this whole start early thing. What are my options? The world of investing can feel pretty overwhelming, kind of like trying to choose from a menu with a million items on it.
It can, yeah. There are a lot of different investment vehicles out there, but some are particularly well-suited for young investors.
Okay.
Let's start with the basics.
Okay.
Retirement accounts.
Okay.
You've probably heard of 401k or 403bs.
Vaguely. They sound like something my parents talk about at the dinner table.
They're actually quite simple. A 401k is a retirement savings plan offered by many employers. And here's the best part. Your contributions are typically pre-tax, which means you're lowering your taxable income right now.
So less money going to Uncle Sam. I'm listening.
Exactly.
But what about those 403bs you mentioned? Are they just a fancier version of a 401k?
Not exactly. They're similar in that they offer tax-deferred savings, but they're specifically designed for employees of nonprofits, schools, and some government organizations.
Okay, got it. So if I work at a nonprofit, I should be
Right.
looking into a 403b instead of a 401k.
Precisely.
Okay.
So another great thing about 401k is that many employers offer matching contributions.
Matching contributions, is that like getting a bonus just for saving for retirement?
You got it. It's essentially free money. Your employer will match a certain percentage of your contributions up to a specific limit. It's a fantastic way to boost your savings without really having to, lift a finger.
Free money. Now I'm really paying attention. What else?
All right, let's move on to another popular option. Individual retirement accounts or IRAs. These are great because you can open them independently, even if your employer doesn't offer a retirement plan. You have a couple choices here, traditional and Roth IRAs.
IRAs. I've heard whispers about these, but I've always been a little fuzzy on the details. What's the difference between these two mystical creatures, traditional and Roth?
The main distinction lies in when you pay taxes. With a traditional IRA, your contributions are often tax deductible, meaning you lower your taxable income now. However, you'll pay taxes on your withdrawals in retirement. With a Roth IRA, you contribute after-tax dollars, so you've already paid taxes on that money. The beautiful thing is your withdrawals in retirement are tax-free.
Okay, so traditional is like delaying the tax bill,
Right.
while Roth is like prepaying it. But how do I know which one is right for me?
It really depends on your individual circumstances and whether you think your tax bracket will be higher now or in retirement. If you anticipate being in a higher tax bracket later on, a Roth IRA might be a good bet. If you're in a higher tax bracket currently, a traditional IRA could be more beneficial.
So it's like choosing between a discount now or a discount later.
Yeah.
That makes sense.
Yeah.
But even with all this talk about retirement accounts, I have to admit, the thought of picking individual stocks and bonds still feels a little terrifying.
I understand that feeling. That's why I often recommend index funds, especially for younger investors. They're a fantastic way to dip your toes into the market without having to become, a Wall Street expert overnight.
Index funds. Those sound vaguely familiar. Are they like those all-in-one meal kits that make cooking super easy?
That's a great analogy. Think of an index fund like a basket of stocks representing a particular market segment, like the S&P 500, which includes 500 of the largest publicly traded companies in the U.S.
So instead of trying to pick the next Apple or Tesla, I'm basically buying a slice of the entire market pie.
Exactly.
That sounds a lot less stressful than trying to outsmart, Wall Street gurus.
And because index funds are broadly diversified, they tend to be less risky than individual stocks.
Diversified, does that mean my money is spread out across different companies and industries? Kind of like a financial safety net?
You got it. Diversification is key to managing risk in investing. And the great thing about index funds is they offer built-in diversification, making them a great choice for beginners who are just starting to build their portfolios.
This is all making so much sense. I'm feeling a lot more confident already. But before we get too carried away with all these amazing investment options, I'm curious, are there any common pitfalls that young investors should be aware of? Like things that could trip us up even if we're starting with the best intentions?
Absolutely. And we'll dive into those right after we come back. Stay tuned.
Welcome back. Before the break, we were just discussing the benefits of index funds for young investors. They're a great way to get exposure to the market without having to handpick every stock.
Right. Index funds sound like a great starting point, especially for someone like me who is still kind of, learning the ropes of investing. But even with these seemingly foolproof options, are there common mistakes that young investors should be aware of?
Yeah, one of the biggest pitfalls I see is letting emotions drive investment decisions.
Emotions. Isn't investing all about numbers and charts and, algorithms? Where do feelings come into play?
It's easy to think of investing as purely rational.
But the truth is, we're all human. And humans are emotional creatures. So when the market is soaring, it's so tempting to get caught up in the euphoria and make impulsive decisions, like chasing after the latest hot stock.
Ooh, I can definitely see that happening. It's like that FOMO feeling, fear of missing out.
Yeah.
But in the financial world, where everyone's talking about this amazing stock that's skyrocketing and you feel like you need to get in on the action before it's too late.
Exactly. But here's the thing. Markets are cyclical. What goes up must come down. And when the market inevitably takes a downturn, those same emotional investors panic and sell everything, locking in their losses.
So it's like riding a roller coaster, but forgetting that there are dips and turns along the way.
Yeah.
You get so excited during the climb that you forget to brace yourself for the drops.
That's a great way to put it. The key to successful investing is to detach from those short-term emotional swings and focus on your long-term goals.
So how do we do that? How do we avoid getting swept up in the emotional roller coaster of the market?
One of the most effective strategies is to create a solid investment plan and stick to it, no matter what the market is doing.
So it's like having a financial roadmap that guides you through those inevitable market storms.
Precisely. Your plan should outline your investment goals, your risk tolerance, and your time horizon.
Risk tolerance. What does that mean exactly?
Risk tolerance refers to your comfort level with the possibility of losing money. Are you okay with taking on more risk for the potential of higher returns, or do you prefer a more conservative approach?
I guess that depends on how much I'm willing to lose sleep over my investments.
Exactly. And your time horizon refers to how long you plan to invest your money. If you're investing for retirement, which is a long-term goal, you can generally afford to take on more risk than if you're saving for a down payment on a house, which is a shorter-term goal.
That makes sense. So the longer I'm investing, the more risk I can handle because I have more time to recover from any potential losses.
Exactly. Now, once you've established your plan, it's important to resist the urge to constantly check your portfolio, especially during times of market volatility.
Oh, I'm so guilty of that.
Yeah.
It's like I can't help myself. I'm constantly refreshing my financial apps, even when I know it's probably not a good idea.
I understand. It's tempting to want to monitor every little fluctuation, but doing so can actually amplify those emotional responses and lead to impulsive decisions.
So what's the solution? Should I just bury my head in the sand and pretend my investments don't exist?
Not exactly. It's important to stay informed, but there is a difference between staying informed and becoming obsessed with every market blip.
So how do I find that balance?
One helpful strategy is to set a specific time to review your investments, maybe once a month, or even once a quarter. This helps you create some healthy distance and prevents you from reacting emotionally to every market swing.
That sounds like a much more sane approach. Out of sight, out of mind, right?
Yeah.
Exactly. And if you find yourself getting overwhelmed or feeling tempted to make a rash decision, don't be afraid to reach out to a trusted financial advisor or even a friend or family member who has experience in investing. Sometimes just talking through your concerns can help you gain perspective and make more rational choices.
It's like having a financial therapist who helps you stay calm and collected when the market is trying to test your nerves.
I like that analogy. Remember, investing should be empowering, not anxiety-inducing. By developing a solid plan, managing your emotions, and seeking guidance when needed, you can navigate the market with confidence and build a secure financial future.
This is all such valuable advice. It's like you're giving our listeners a superpower. The power to make smart, informed decisions, even when the market is feeling a little crazy.
That's the goal. And remember, even small, consistent actions can lead to significant results over time.
So are we ready to dive into the final part of our deep dive? I'm excited to hear what other gems of wisdom you have in store for us.
Absolutely. Let's wrap up with some actionable strategies that will empower you to start investing today and build a solid foundation for your financial future.
Welcome back. I feel like we've already covered so much in this deep dive on investing for young people. Like we talked about the power of compounding, the magic of starting early, and how to avoid letting those pesky emotions, hijack our investment decisions.
And we talked about different retirement accounts like 401ks, IRAs, and index funds. All great options, especially for younger investors.
Right. But I have to admit, even with all this knowledge, I still feel, a little hesitant to actually take the plunge. It's one thing to talk about investing, but it's another thing to actually do it.
Yeah.
Where do I even begin?
That's a great question, and one that a lot of young people have. I think the key is to break down the process into smaller, manageable steps.
Okay.
Think of it like training for a marathon.
Okay.
You don't start by trying to run 26 miles on day one, right?
Okay.
You gradually increase your mileage over time, building your endurance and confidence along the way.
Okay, I like that analogy. So what's the first mile marker in this investing marathon?
A great starting point is to take a look at your current financial situation.
Okay.
Where is your money going each month?
Yeah.
Do you have a budget?
A budget, that sounds vaguely familiar, but I haven't really given it much thought. Is it really necessary to track every penny?
It doesn't have to be super detailed, but having a general idea of where your money is going can be really helpful. It allows you to identify areas where you might be able to cut back and free up some extra cash to invest.
So it's like giving my finances a little checkup.
Yeah.
Seeing what's working and what needs some attention.
Exactly. Once you have a clear picture of your income and expenses, you can start setting some specific and achievable savings goals.
Savings goals, is that different from investment goals?
Think of savings goals as the stepping stones to your investment goals. So let's say you want to start investing in a Roth IRA, but you need to build up a little cash cushion first. You could set a savings goal of, say, $500 or $1,000, and once you reach that goal, you can transfer that money into your Roth IRA.
So it's like creating a little financial runway before my investment plane takes off.
That's a great way to think about it. Now, once you have some money set aside, it's time to start putting those dollars to work for you.
Okay, this is where things start to feel a little scary again.
Yeah.
How do I actually choose what to invest in?
Well, remember those retirement accounts we talked about earlier? If you have a 401k through your employer, especially one with matching contributions, that's a fantastic place to start. Even if you just contribute a small percentage of each paycheck, it's a great way to start building that nest egg for retirement.
It's like getting a bonus just for being responsible.
Exactly. And if you don't have a 401k, you can always open an IRA on your own. There are tons of online platforms that make it super easy to set up an account and start investing.
So it's like online shopping, but for my financial future.
You could say that. And remember those index funds we talked about. They're a great option for beginners because they offer instant diversification and low fees.
It's like having a personal robot advisor who curates a balanced portfolio, just for me.
That's a great analogy. Now, a couple of other things to keep in mind as you embark on your investing journey. First, don't be afraid to ask for help. There are so many resources available, from financial advisors to online articles and podcasts, that can provide guidance and support.
It's like having a financial Sherpa to help you navigate the terrain and reach those summit goals.
Exactly. And second, remember that investing is a long-term game. There will be ups and downs along the way. But if you stick to your plan and stay focused on your goals, you'll be amazed at what you can achieve.
This has been such an inspiring deep dive. I feel so much more, I don't know, confident and excited about investing now. Thank you so much for all of the amazing insights.
You're very welcome. And remember, even small, consistent actions can lead to really significant results over time.
So true. To our listeners, remember that investing is a journey, not a destination, so enjoy the ride. And most importantly, invest in yourself and your dreams. Until next time, keep diving deep.